Global front-end yields explode higher as central banks combat inflation. A Tesla gamma squeeze fuels an equity market melt-up. And all eyes on the Fed, who are expected to start tapering this week. All this and more in this week's Macro Insight. Welcome back to Macro Insight, everyone. Today is the 2nd of November, and let's take a look at these markets. So last week, what happened last week? We saw more weaker data in general. So you had US GDP missing estimates. You also had ISM new orders a bit lower. Starting to see durable goods rolling over, confidence still not amazing. So, general data points signaling growth slowing down. But then on the flip side of that, any inflation or price data points still remaining elevated, right? So what we've been saying over the last few weeks, all the data is coming in very stagflationary. Market's not in love with that. And that is partly why we are seeing the yield curve flattening the way we are. Okay, let's share a screen, a few charts. So now we've been saying, right, that the job growth, that's going to start off this price wage spiral thing. And for inflation to really get out of control, is the job growth is the concern. So you've got this Bureau of Labor Statistics employment cost wage private industry workers index, basically. And that's up at 4.6%. So if you look at how far that goes back to 2000, I mean, that's a pretty high number. Okay. So, the Fed constantly calling inflation transitory and saying, there's no wage growth. That's why it's transitory. Well, here's your wage growth, right? And then the other chart obviously shows the ISM report from yesterday, where you've got the new orders in blue rolling over, and then you've got the prices index going up, basically, right? So all the data kind of putting the central banks, not just the Fed, but central banks in general, into a bit of a tough spot. And that's kind of what's led to some of the crazy price moves that we've seen in rates last week, right? So if we have a look at this chart put out by Macro Hive, to just look at, what are the assets that are really moving if we normalize them for their standard deviation of moves. And you look, all the big winners last week were 5 to 6 sigma moves in Aussie 2-year rates, Sweden, Switzerland, Canada, right? Canada surprised on the hawkish side in their central bank meeting. Oz had some high CPI numbers, market got spooked. You had the craziest move in 2-year Australian rates from like 10, 15 basis points to 70 odd basis points, right? So that was some pretty dramatic moves. And then what else happened? You also had Japan up 2% over the weekend with their election, their snap election, LDP retaining control, market pricing in, more likely to see some stimulus in Japan, right? So people had got a bit bullish Japan about a month ago, that got flushed out. Now that rally's kind of resumed again, people thinking the political situation is going to be more favorable. This kind of move in rates, it does look like central banks globally have kind of been caught a bit behind the curve on inflation. And they're all signaling that they want to do something about it and that they're going to have to, taper, hike rates, things like that. And I think the rates market has just got caught a bit flat-footed, and that's why you've seen such dramatic moves up in the front end, and then the back end is doing the opposite because they're thinking, oh God, we're not hiking rates because growth is good necessarily, but we have to calm down this inflation, right? So that's what the global kind of yield curve flattening that we're seeing everywhere is kind of starting to happen and put pressure on these central banks. This is quite a nice chart. So if you look at the US yield curves, you've got this kind of convergence going on between the 2s, 5s, which is basically the front end of the yield curve, and the 530s, which is the back end. And, if you look at past episodes of that tends to happen, when we're at the start of a hiking cycle, which can often also mean, we're heading into a recession, right? Now, normally we know that inverted yield curves are often a bit of a signal for a recession. And, if you look at these 530s, that's not inverted yet. But the 2030s went inverted last week. That went to like -5, which is a little bit spooky. And I think that was partly what kind of triggered that quite dramatic move in rates, right? Now, if you look at TLTs, now I have been long TLTs. I took them off yesterday because I'm just thinking it's so whippy right now going into the Fed. Did I just want to have an outright delta position? Wasn't sure. But then you look at the short interest in TLTs, it's the highest on record. So there's obviously a chunk of money playing yields going higher, and the fact that we're expecting tapering announcement on Wednesday. I'm considering switching this position that I had. Obviously, I've got some longer term in my sort of pension. I've got some allocation to long-term bonds, but not massive, but some. But I'm thinking of maybe topping it up with some sort of call spread structure, because I don't really like the growth outlook going into Q1. Whilst we might get a bit of a mini reflation type bounce like Darius has been calling for, and we're starting to see a bit of price action to confirm that, like the Russell, for example, yesterday. I think in Q1 we're going to struggle. We're going to see growth roll over. So I want to have some TLTs on, but I think there is risk in just doing it in outright delta, because if it goes the other way, it can go quite a long way. So I think call spreads are probably the trade to look at. So I'm going to be looking at some call spreads ahead of the Fed, see what you can get on in the 3 to 6 month duration, see if the risk reward that it's giving you looks decent. I think outright calls are going to be pretty expensive, given that vol in rates has spiked, given where the move index is, etc. But I think call spreads might be the way to kind of have some exposure to that, the idea that we're going to struggle on the growth outlook. And even if they hike rates in the front end, they're kind of they're borrowing those rates, or the market is seeing that as some kind of policy error. So the long end of the curve doesn't really need to fly. All right, so that's what I'm looking at right now in rates. Tesla squeeze outshining the tech earnings. So if I share this screen to show you what all the sort of tech stocks have done over the last week. So you've got all those mega cap techs there, and you can see that Microsoft and Google are up about 5%-ish, both of them on decent earnings. Apple and Amazon, we know, disappointed. The stocks were down, but they kind of net on the week are a bit flat. It's not bad, given that they missed. And then Tesla has just ripped another 20% odd, right? So clearly, it's whilst the big cap tech earnings were what we were focusing on, Tesla is really what we should have been looking at, given its massive weighting now in the index. I mean, it accounted for, I believe, 80% of the NASDAQ move yesterday or something like that, which was a bit crazy. What else? Wednesday, we've got FOMC, obviously big anticipation there in terms of the tapering. To begin, size and pace of it is really what we're looking for, and what the rate hike timeline will be. Goldman's have been calling for July 22, and then for the first hike, and then November next year for a second hike. Sounds pretty punchy. So here you can see the market implied number of rate hikes, right? So, we've got a hike by June, 1.6 hikes by September, and 2.5 hikes by December. So and if you look at the chart below, that's the Fed dots, okay? So we've got the Fed dots in the red, on the red line, and we've got the markets pricing in the black line. So next year, it's barely moving, like the Fed dots have barely moved really for next year, whereas the market's saying we don't believe you, basically market calling bullshit on the Fed there, right? And then same thing for 2023, but then if you look to 2024, the market's pricing lower than the Fed's estimation of where rates will be, right? So the market pretty much telling the Fed, you need to act now, and you ain't going to be doing hikes in the future, because that's going to take growth down. right? So we'll see what the Fed comes out with and whether they revise any of the dots or anything like that. I'm not even sure if we get a bunch of dots in this meeting actually, but we'll see. So, okay. And then lastly, Bank of England on Thursday. Are they going to hike or not? So market's kind of 50-50 to slightly thinking they're going to hike, given that, you know, the governor Bailey is slightly more on the hawkish camp. But it seems as though there's enough doves on there as well that it's going to boil down to what Broadbent and Cunliffe, deputy governors, what they do basically, right? So talking about hiking from 10 bips to 25 bips, if they're going to hike, the market, you know, has got a bit aggressive again in terms of pricing that. But are they going to wait to see what the jobs numbers look like in terms of the furlough scheme rolling off and impact on the labor market and things like that? So I would say that, you know, there is a decent chance that they're going to wait to see more data, and we might get it, you know, in December rather than now. The market, you know, sterling obviously rallied, has pulled back a bit. So obviously there's been a bit of tempering of those expectations. But if you look at euro sterling, that was arguably still, you know, has come off quite a lot. So in terms of the trade, you might not want to take a dollar position against sterling, given, you know, you've got the FOMC this week, but buying some euro sterling, potentially if you get a disappointment and they don't hike, you potentially got some upside there basically. Right. Now that euro sterling's already bounced a bit off that sort of 84.5 level, you know, how much more upside has it got? Probably 86 as a max. But, you know, that might be one way to play it if you don't think the UK is going to hike this week. Yeah. And then lastly, non-farm payrolls on Friday, 400K expected. Obviously, last month was a big miss. It's not going to affect the tapering decision because that's already going to be out, but it may well continue to flatten the yield curve if we see a bad number coming out again on non-farms, right? So something to keep an eye on there. So, you know, that may well fuel another leg up in that long bond part of the yield curve, which is why I probably want to get some of those call spreads on before those numbers come out. Yeah. Okay, so then commodities. In terms of commodities, oil, the big one. Had a little bit of a pullback, but you blink and you miss it really with these oil pullbacks. Trend's still very, very strong, right? So US tried to put some pressure on OPEC to raise output to calm prices. Prices pulled back a little bit on gas prices coming in as well after, you know, Russia saying that they pump to Europe. Inventories, though, are still pretty low heading into winter. Apparently, there's a bit of a shortage at Cushing as well, which might create a bid to WTI in particular. So prices will be supported on those weaker inventories. And then, you know, even OPEC members like Nigeria and Angola are struggling to meet their quotas in terms of production, right? So still lots of support fundamentally for oil. So I don't really see that rolling over anytime soon, right? And, you know, some people are still calling for getting, you know, 90 to 100, maybe even by year end, right? So just keep an eye on that. But that bounce after that pullback was pretty violent. So the price action remains very strong in oil. Yeah. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.